Good morning. My name is Joanna, and I will be your conference operator today. At this time, I would like to welcome everyone to the Battle North Gold Bateman Gold Project Feasibility Study conference call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question-and-answer session. If you would like to ask a question during this time, simply press star, then the number 1 on your telephone keypad. If you would like to withdraw your question, please press star, then the number 2. Thank you. I would now like to turn the meeting over to Alan Candelario, Director of Investor Relations and Corporate Development. Please go ahead, Alan.
Thanks, Joanna. We are extremely pleased and excited to be presenting the summary results of the feasibility study for the Bateman Gold Project. We would like to remind all the listeners that today's call and discussions, including the presentation materials and responses to questions, will include forward-looking information and forward-looking statements related to the future performance and condition of the Bateman Gold Project and the company. Such information and statements are based on assumptions, estimates, expectations, and opinions which are considered reasonable and represent best judgment based on the available facts as of the date of such statements, and further are inherently subject to various risks, uncertainties, contingencies, and other factors. Accordingly, actual results could differ materially than expressed or implied by the forward-looking information and forward-looking statements. Please refer to the cautionary statement on forward-looking information and the endnotes of the presentation, as well as the cautionary statements at the end of the related news release we issued this morning. I'd now like to turn over the call to George Ogilvie, President and CEO of Battle North Gold.
Thanks, Alan, and good morning, everyone, and thank you for participating in today's technical session conference call, where we will discuss the summary results of the maiden feasibility study for the Bateman Gold Project released this morning. In addition to Alan, I'm also joined by Mike Willett, our Director of Projects. I trust that you've all had a chance to review the news release. It's also available on our website and under our profile on SEDAR. I will first review the presentation slides provided in the webcast and on our website at www.battlenorthgold.com, following which we will open up the lines for question and answer session. We will try to keep our presentation as brief as possible in order to allow for more time for Q&A. Before commencing the presentation, as a reminder, we direct your attention to the cautionary statements on slide 2 and the end notes, as well as the cautionary statements of our earlier press release. So hopefully you've all had a chance to open up the live webcast and have the presentation in front of you. Obviously the topic of the presentation is the Bateman Gold Project Feasibility Study. I draw your attention to the cautionary statements, as we've already mentioned. So let's talk about the value proposition for Battle North Gold. I think there's many elements of the value proposition, which includes a very accomplished management team with a proven track record of turning around difficult stories and difficult assets. We have a strong balance sheet and very strong institutional shareholder support. Obviously, the project is located in Red Lake, which is one of the most prestigious gold mining camps in Canada, if not the world, a Tier 1 mining jurisdiction. We've just released our maiden feasibility study this morning, built off of sound engineering principles, which shows a very robust project at very conservative gold price assumptions and exchange rates when considering today's spot prices. As you all know, there's been significant investment in the Bateman Gold Project over the years, so we have significant infrastructure already in place, and the project has many of the permits required and is shovel ready. There are significant tax loss pools. We have organic growth opportunities, all sitting within 2 kilometers of the mine and the mill infrastructure. And of course, we have 28,000 hectares of prime real estate in Red Lake that we're about to begin exploring upon. So you'll have seen this slide before with respect to the management team. New names that you'll have seen added would be Eric Setchell. Eric Setchell has been with the company for 2 years. He is our general manager in Red Lake. He brings to the table over 30 years of underground experience and will obviously be critical in ensuring we can implement the feasibility study and take the mine through to commercial production. In recent months, we've also added Nick Haydock as a full-time employee who brings over 20 years of experience as a corporate lawyer with former senior positions with Lundin Mining and Kinross Gold. I should also add that we're in the process of hiring a corporate HR manager, and we're also in the process of hiring a regional exploration manager. So as you can see, we're really adding to the team that will allow us to grow this company and execute on our feasibility study. A little bit about the balance sheet. Today, as we're on the call, we have approximately 67 million Canadian dollars cash in the bank. There's $10 million of that which has to be allocated to the regional exploration program, and those monies have to be spent by December 31st, 2021. Effectively, that leaves about 55 million Canadian dollars today cash in the bank that can be allocated towards the project once approved and given the green light by the board of directors and myself. Obviously, we have the Sprott loan facility, which, as you know, we pushed out the maturity on that to December 31st, 2021, which is still some 14 months away. Today, 129 million shares issued on a fully diluted basis, 136 million. Share price closed yesterday at $1.67, giving the company a market cap of 215 million Canadian dollars, which obviously is significantly below the valuation of the company based on the feasibility study that we put out this morning. 8 analysts covering the company with a target price of $2.75 to $5.50. And as you can see, we have an extremely strong institutional shareholder registry. Many of those groups have been with us over the last 4 years as we've slowly but surely turned around this company and de-risked it from a technical aspect. A little bit about Red Lake. I'm sure you're all very well aware that Red Lake has been mining gold for close to 80 years. Within the camp, there's 55 million tons that's come out from there, producing 29 million ounces of gold. And you can see there at the bottom of the page as a reminder that in 2018, we put 35,000 tons of ore through our mill and saw a recovered head grade of 4.5 grams, and that produced just under 5,000 ounces of payable gold. A little bit now, obviously, about the feasibility study itself. So the base case economics were based around a $15.25 gold price or a 0.74 or 1.35 exchange rate. That generated an after-tax IRR of just over 50%. The NPV using a 5% discount factor on the project was $305 million. And over the 8.2-year entire mine life, we generate approximately 418 million Canadian dollars in real free cash flow. The initial upfront capital, which we'll look at in a bit more detail shortly, is 109 million Canadian dollars, and that's inclusive of a 10% contingency. That compares quite favorably with the $101 million, including contingency, that we had within the PEA that went out last year in 2019. When we work through the numbers, it appears that we have a funding requirement of $93.2 million, which includes $8 million of corporate G&A. So if we have 55 million Canadian dollars of cash in the bank today, it's saying that we have to raise an additional $40 million in debt to have a fully funded project. The feasibility study is also showing that timelines to initial production are 7 months once we greenlight the project. Now, within the feasibility study, all the critical path items are scheduled to start the 1st of April 2021, and 7 months from that date would mean that first ore production would be on the ground in November of 2021. There is an opportunity, however, that if the board of directors greenlights the project before the end of this calendar year, we could see a 3 to 4 month head start on the timelines within the feasibility study. The ramp-up period to commercial production would be an additional 14 months or 21 months in total to the declaration of commercial production. As we said earlier, the feasibility study is showing 8.2 years entire mine life, of which 7 years are commercial production. That's 2 years more than what was in the PEA. And we believe that we can provide the mill with additional feed over time through the McFinley and the Penn zones, where we anticipate putting out 43-101 compliant resources towards the end of this year and early in 2021. So we've looked at the KPIs at 1525. If we now look at the project at today's spot price of $1,900 US, you can see the after-tax IRR suddenly jumps now to 86%. The NPV in the project would be 531 million Canadian dollars, and there's almost 700 million Canadian dollars in real free cash flow. Now, you should also note that at 1525, after 8.2 years of mining, there's still $406 million in unused tax pools remaining, and at $1,900, we actually deplete the $704 million of current tax pools, but because of the capital and the sustaining capital that we put into the project, we find that at the end of the 8.2 years, we're sitting with approximately 143 million in available tax loss pools. So it's still fairly significant. Here's a breakdown now of the capital costs. So we have 55 million Canadian dollars going in principally to underground development and infrastructure. I believe there's approximately 8,500 meters of development pre-commercial production, and the development rate unit cost is somewhere between $5,000 to $6,000 per meter. So you can see there that there's approximately $45 to $50 million of that 55, which is going into underground development. Over the 7-year mine life, commercial production, we're showing 125 million of sustaining capital. We're purchasing the equipment in a 5-year lease, so there's a 10% upfront payment and then monthly payments over a 5-year period. On surface, there's $35 million that goes in principally to initially raising the tailings impoundment area dam by a couple of meters. There's a primary crusher, which we're intending to put in on surface. And there's also an ammonia reactor, which has to go into the wastewater treatment plant to allow us to treat for ammonia before we discharge to the natural environment. So on the upfront capital side, including the contingency, it's 109 million. You'll see there on the sustaining, it's 188 million. And if you divide that by the 7 years of commercial production, it comes in around 27 million Canadian dollars per annum, which is in line with the PEA, which forecast 30 million Canadian dollars per annum. So over the 21-month ramp-up period, as we said, from month 7 to month 21, we obviously have a working capital requirement, which is showing at 62.5 million. There's obviously royalties and taxes to be paid there. We have a 3% NSR, 2% which belongs to Franco-Nevada, and a 1% NSR which belongs to Royal Gold, which has to be paid. And there's 48,000 ounces approximately of pre-commercial production. And at $1,525 US gold price, that would generate 98 million Canadian dollars in revenue from gold sales. That gives us approximately $34 million of positive free cash, operating cash flow from the pre-commercial production period. And then when we deduct that from the 109 million of initial capital, it gives us 75 million. We do our inventory adjustments, and we also do add in the corporate G&A, which, as I said earlier, was 8 million. It gives us a funding requirement of approximately 93 million. I think there's a good opportunity here, given the close proximity to first production, that we might be able to sell our gold in the second half of 2021 at a much higher gold price than the 1525 that we're showing here. But we'll look at that obviously as we move into next calendar year and get closer to production. So here's a schematic that came out of the feasibility study on the right-hand side. As a reminder, everything that's in purple is already a sunk cost. What you're looking at in blue there is the light cyan, is the pre-commercial production development, and that's some 8.6 kilometers. And then you can see the green as the sustaining capital development. One of the changes that we noted was that when we did the stope planning, particularly with respect to the geomechanical and the geotechnical aspects of the stopes, we had to make the stopes smaller in order that they could be more stable than what was in the PEA, and that therefore gave us more development that went into actually mining the stopes. So the overall development actually moved up. Of course, it would move up as well because there's an additional 2 years of mining when compared to the PEA. The plan that we put together here over the pre-commercial production period pushes out the capital development 9 months ahead of the mining crews. So when we declare commercial production, we anticipate that we'll have 40 to 50 stopes available for mining. All of these stopes would have then been drilled off if they're not already on a 10-meter drill density, so that we're very confident we can maintain our grade profile as given to the market in our forecasts. And as you can see, it's a steady, slow ramp up to commercial production, which we define as running the mill at 70% of its permitted capacity over a 90-day consecutive period. And I think 70% of 1250 would be around 900 metric tons per day. We've already cleared the ground for the portal, and we're anticipating that early next year we'll be able to start that work up ahead of the schedule that's currently shown within the feasibility study. Obviously, the ramp through to surface is a critical path item. Slide 15, here you can see the production profile that came out of the feasibility study, very similar to the PEA. You can see on average, over the 8.2 years, we produce just under 80,000 ounces of payable gold per annum, with a diluted head grade reporting to the mill of 5.54 grams, which was slightly better than the 5.3 grams we had in the PEA. You'll notice that the average annual throughput is around 1,315 tons per day, peaking out at just under 1,500 metric tons per day. And again, like the PEA, the mill is built for 1,800 tons per day, and we would envisage that before declaring commercial production, we would apply to have the permits amended for the mill from 1,250 tons per day to 1,800 tons a day, giving us lots of capacity as we move into commercial production. And therefore, if we could find incremental feed from the string of pearls, that could improve the margins for the company. We're looking at a C1 cash cost of $613 an ounce. I believe the PEA was $624. We're looking at 865 all-in sustaining costs US dollars an ounce against an 884 in the PEA, and the all-in cost, which obviously includes all our taxes, G&A, corporate, and the upfront capital, comes in at just over $1,000 US dollars an ounce. So very robust. Here we're showing a little bit of detail on the stope methodology, and the size of the stopes themselves. Now remember, when we did our bulk sample 2 years ago, the principal mining methods deployed successfully were sub-level long hole and uppers, and you'll see that those two mining methods account for 80% of the tons that come out of the mine based on our feasibility study. The other two methods are mass blast raise mining, which would be new to the Red Lake camp, but has been used extensively in the Hemlo camp. So we're confident of executing on that. That accounts for 13% of the tons, and 7% of the tons comes from cut and fill. We've broken out the cut and fill into the ultramafics, where obviously we've got an extremely soft, elastic rock. We're planning on going at a much slower rate through the ultramafic, and there's also significantly more ground support required. That's why you'll see the mining cost per ton there is $234 a ton. And on the cut and fill, when we go through the basalts and the felsics, which is a lot more competent rock, we're looking somewhere around $139 a ton. I should also draw your attention to this, that for the cut and fill, the cutoff which we used, the grade, was a 5 gram per ton cutoff. And for the other mining methods, we used 3.3 gram per ton cutoff. So the blended weighted average cutoff for the reserves was essentially 3.41 grams per ton if you include the cut and fill with the 5 grams. Here you can see the sensitivities in the table. We're showing the sensitivities against gold price and exchange rate. I think I'd like to draw your attention to US dollars 13.25. That was the base case price we used in the PEA. When we did the PEA, we had an after-tax IRR of 40%. Here we're showing 32%. That's because there's been an increase in initial upfront capital and working capital, which drove down the IRR. But on the NPV, we went to 178 million versus 135 million in the PEA. And there's about $230 million in free cash flow at 13.25 versus 192 million in the PEA. So all in all, our feasibility study has actually, in my opinion, improved upon the results that we put out within the PEA, and yet we did a lot more detailed study, a class 2 engineering feasibility study. And there you can see what the project looks like at $1,900 an ounce. If we look at the sensitivities as well for throughput, grade, life of mine, capital costs, and operating, you can see that the project is most sensitive to obviously grade and throughput. So we based our reserves on $1,375 an ounce gold. And as I alluded to earlier, there's every prospect here that next year we could be pouring gold doré bars in the second half of 2021. And I think one of the things that we'd want to do as an organization is to take a look at the reserve and the resource, perhaps at a higher gold price, to see what that does to the size of the shapes, the tons that might be available, the ounces, the grade, and does that give us a more profitable business plan? So that's definitely an opportunity or a scenario that we're going to have to follow up on over the course of the next 3 months as we prepare our budgets for 2021. We believe that there's still significant exploration potential, both at the Bateman Gold Project itself, given the deposit has never been cut off across strike nor at depth. And of course, we have these other opportunities that we're following up on now that are all within 2 kilometers of the mine and the mill. Our feasibility study envisages using electric battery-operated trucks on the main ramp. The other equipment is diesel. There is an opportunity over time where the full production fleet could move over to battery electric operated. And although the mass blast raise mining shows a higher cost per ton than the long hole and the uppers, that's only due to the fact that the mass blast raise mining stopes are much smaller than the more conventional long hole mining method. If we were able to successfully conduct mass blast raise mining and then deploy in those larger stopes, we believe that would actually drive down the unit cost below the current long hole stoping and the uppers mining method. So perhaps an opportunity over time to drive down some of our operating costs. So I'm happy to report maiden reserves for this project. Today, we're currently looking at reserves of proven and probable of 3.5 million tons at a diluted head grade of 5.54 grams per ton, giving us approximately 635,000 ounces of contained gold. Now, that was all done, as I said earlier, at $1,375 gold price. Behind that, we still have 1.5 million tons at 7.24 grams or 350,000 ounces of resource in the measured and indicated category. And behind that, there's 1.3 million tons at 6.5 grams or 270,000 ounces of inferred material. And of course, what we'll be looking to do now that the project is hopefully moving forward at the end of the year into final construction and then production next year is we'll be deploying a lot more dollars into further infill drilling and exploration at the Bateman Gold Project itself to try and increase our reserve and resources and extend out the life of mine beyond the current 8 years that we're currently showing. So the project's substantially permitted. As you know, we have a 1,250 metric ton per day mill. The key aspects in the mill that need to be upgraded, as we said, are the wastewater ammonia treatment system. And also we have to put in a primary crusher on surface that will crush the ore from the run of mine down to 6-inch minus, which is the optimum feed for the mill. In the first year, as we approach commercial production, we'll be looking to apply to have the permits amended to 1,800 tons per day. We're confident within 12 months, which is a timeline we're giving ourselves, that we, given it's Red Lake and the community is mining friendly, we believe we can have the permits amended over that 12-month period. We've started initial discussions with our 2 First Nation groups with respect to an IBA, and we're confident that at some juncture in the second quarter of next year, we should be able to announce a successful IBA. And we also have our closure cost, and you'll notice that that is being offset by approximately $7.6 million of salvage value from the assets of the company at the end of the mine life towards 2030. So as a reminder, we have the 1,250 ton per day permitted mill. There's a 720 meter deep shaft with a full functional hoisting system, 10-ton skips that sit over the cage. On a 20-hour a day basis, the hoisting system can hoist at least 2,500 tons of rock per day. There's a 200-man camp, which we're busy preparing for the first 100 beds as we speak. And there's a septic field bed system that'll be going in there before Christmas to allow us to handle the grey water from 100 or so employees that we'll be looking to bring on starting the first quarter of 2021. There's a fully functional tailings impoundment area. We have access to fresh water. And as you know, there's a 44 kVA electrical line right into the mine site and 2 5 kVA feeder cables going underground. Caution headframe for evolution is in the back right-hand background. And in the center of the page in the background, you can see the Red Lake gold mines, the headframe for Red Lake and Campbell, and processing facilities that belong to Evolution Mining. Here you can see a photograph inside our state-of-the-art mill. It's a SAG mill feeding into 2 Nelson concentrators. Some areas of the mill were even built by the initial management team for 2,500 tons per day. So the mill is expandable for only a small incremental capital cost, well beyond its 1,800 tons per day. The Nelson concentrators performed extremely well in our test trial mining 2 years ago, giving us 43% of the gold coming off with gravity. And overall, the mill had a 95% metallurgical recovery, which is the numbers that we're duplicating or using in the feasibility study. And we ran that mill on several days at around 1,540 tons per day, which, as you saw from the tonnage throughput, was well below the peak tonnage that we're envisaging from the feasibility study in the Bateman Gold Project itself. Here we show the impact of the tax pools at various scenarios of gold price. As I said earlier, once you go beyond $1,900 an ounce, the $704 million of tax pools are depleted. However, because of the new capital and sustaining capital we put in, there are tax pools still available to the company. So here we can see the string of pearls on this section. First of all, let's talk about McFinley. McFinley was a former producing mine that was briefly in production in the late 1990s, early 2000s. Today it has a non-compliant resource of 67,000 ounces of gold at 6.8 grams per ton in the ground. That's only down a couple of 100 meters below surface. We have 3 levels which are already tied into the McFinley mine on the 46, the 84, and the 122 level. And it's our intention to release a compliant 43-101 mineral resource estimate before the end of the calendar year on McFinley. And hopefully that could provide us with incremental feed into the mill over the next couple of years. Interestingly, you'll see with McFinley that several years ago now, we poked out a 700-meter deep hole, as deep as 685 meters below surface. Importantly, we had the same lithology, stratigraphy, structure, mineralogy as what we see at McFinley, some 550 meters higher up in the package. And all of this sits approximately 500 meters away from a full production shaft and a big hungry mill sitting on surface. The same strategy is being deployed for the Pen Zone. In April of this year, we had a diamond drill set up on our 244 exploration drift. The Pen Zone was drilled with a 2,700 meter program. Approximately it's 500 to 600 meters away from the end of that exploration drift. And it's our intention to produce a compliant resource on the Pen Zone at some juncture early in 2021. And again, this deposit has not been cut off at depth. If we look at the camp as a whole, you can see Battle North Gold's land package is highlighted in the dark blue. You'll notice how it's adjacent to a lot of the areas which are highlighted in red and pink, which belong to Evolution Mining, the new mid-tier Australian company which came into the camp recently with the acquisition of the Newmont Goldcorp assets. And we certainly think that there's a lot of synergies between our respective land packages and some of our claims which join one another. That circle you see there is a 10-kilometer radius circle out from the Phoenix Gold Project. You'll notice how it encompasses the Red Lake, the Campbell, and the Koshna properties which belong to Evolution. And if you follow that mine trend of mineralization through those properties, it takes you on to McQuaid, DMC, and Slate Bay, which are properties which are 100% owned by Battle North Gold. Another interesting project for us would be Sidus Lake and also East Bay. At East Bay, where we have previously drilled at depth, found mineralization with the same stratigraphy and lithology as what Evolution has at the gas zone, which is much higher up in elevation. So we think that potentially that mineralization extends over the imaginary boundary, comes onto our property at depth. So potentially some synergies there as well. So to conclude, I think you would all agree with me that we've got a very accomplished management team with a proven track record of turning around difficult stories and broken assets, a very strong balance sheet, 55 million Canadian dollars ready to allocate to this project, a very strong institutional shareholder registry, which is unusual for a company of our size and where we are with the company's evolution. But I think that's a credit to the management of the company and the strong fundamentals over the last couple of years as we've slowly but surely de-risked this project. We're located in one of the best mining jurisdictions in the world, not just Canada. It's geopolitically, socioeconomically, tier one, very safe mining jurisdiction. We've put out a very robust feasibility study based on what I would say are conservative assumptions and very, very sound engineering. So we're very happy with those results, and we think there's a lot of upside from this feasibility study still yet to come. As you all know, significant infrastructure is in place. The project has significant permits and essentially is shovel ready. We have substantial tax loss pools, and of course this huge organic growth opportunity from the String of Pearls, and we're about to begin regional exploration within the camp and on our properties. So with that, I'd like to close off the corporate presentation and open up the call for any Q&A that anybody may have at this point in time.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Should you have a question, please press the star followed by the 1 on your touch-tone phone. You will hear a 3-tone prompt acknowledging your request. If you are on a speakerphone, please lift the handset before pressing any keys. And the first question comes from George Topping at Industrial Alliance. Please go ahead.
Yeah, great. Hi, George. Hi, everyone. George, lots of detail. That's great. Could you just give us some information on the availability of labour, particularly the skilled underground labour that you're going to need, particularly in the startup of the operation?
Yeah, the way in which we've planned the project initially, George, is it'll be all contracted labour predominantly through the pre-commercial production period. And then once there's a handover or a declaration of commercial production, 80 to 90% of our labour will then be owner-operator. As you know, we're in a fortunate position where we have a 200-man camp already built and available to us on our property adjacent to the mine. And we would envisage utilising that camp. So the way in which the project is costed at the moment is that 50% of our labour comes locally and 50% of our labour is being costed as fly in, fly out. We're in the process actually of engaging our own EPCM team, and I'm happy to say that that team is now in place. And we're busy putting together the detailed project execution plan, which will feed into our budgets for next year.
Okay, and then one follow-up on that would be the in the startup phase. I see you've added an extra contingency on the costs for the first 50,000 ounces pre-commercial production. Looks like about 1,500 Canadian. Per ounce. How confident are you that that's enough? As you're well aware, the startup's always the hardest part.
Yeah, I'm fairly confident, George. I mean, I think there's an opportunity here as well, as I said earlier, that the feasibility study is showing a start-up of the 1st of April. And assuming the board of directors approves the project before year end, once the technical report is actually filed, I think we've got a wonderful opportunity for actually getting a head start on some of the critical path items. And, you know, some of the initial stopes that we're targeting are obviously very much in the measured category, where the drill density today sits at 8 meters. So we have a lot of confidence in the resource modeling and the reserve modeling that's coming out of those stopes. But certainly the sooner we can get there and get our test chip and muck samples and get our ore sitting on surface and get it sampled, the more confident we will be. And you know, the opportunity, and I touched on this as well, is once we start to get some visibility on first ore on the ground, I think we've got every opportunity to do some forward sales, a little bit of hedging. Not a big fan of that, but bringing your first project into production can be a bit tricky, and maybe this one a wee bit trickier than others, given the legacy and given we've got a great opportunity for potentially selling our gold in the second half of next year at prices well in excess of the $15.25 US that we're actually using in this model.
Yeah. Good. Okay, thanks, George. I'll pass it on to the next analyst.
Great. Thank you, George.
Thank you. And as a reminder, should you have any questions, please press star one now. There appear to be no further questions at this time.
Okay, great. Well, thank you, operator. Well, on behalf of the Battle North Gold team, I'd like to take this moment to thank our shareholders and our stakeholders, including the Red Lake community and the local First Nations, for their continued support of the company. We delivered a robust and positive feasibility study for the project that looks even more compelling at current spot gold prices. We look forward to updating you on the Bateman Gold Project with exciting milestones planned over the next 12 to 24 months. Thank you for your time today. Stay well, everyone, and we'll talk to you later. Thank you.
Ladies and gentlemen, this concludes your conference call for today. We thank you for participating, and we ask that you please disconnect your lines.